Chipotle's recent performance has definitely caught people's attention. Over the past year, fewer customers have been visiting their restaurants, and the company's stock price has taken a pretty steep dive, down about a third from where it was. This isn't just a blip. It's a sign that something's shifting in how people are spending their money on dining out. When a big name like Chipotle faces a full year of declining traffic, investors and analysts start to wonder what's behind the change and what it means for the future. So, let's break down what's really going on here. Let's decode the term same-store sales. Basically, it measures how much revenue existing locations are bringing in compared to previous periods, without counting any new stores. For a company like Chipotle, this number is a key indicator of whether their current restaurants are attracting more customers or not. When the outlook is flat, like Chipotle's forecast for 2026, it means they don't expect any growth from their established stores. That's a big deal because it signals that the business isn't getting busier, and for a major chain, stagnant sales can point to deeper issues with customer demand or competition. So why is everyone suddenly fascinated by the ups and downs of fast food and fast casual chains? It's not just about burgers and burritos. It's about how these businesses reflect bigger shifts in the economy. As inflation bites and wages struggle to keep up, people are becoming more selective about where they spend their money. Chipotle's recent struggles, like declining customer traffic and flat sales forecasts, are actually part of a wider trend hitting restaurants everywhere. When a giant like Chipotle feels the pinch, it's a sign that the whole industry is wrestling with changing consumer habits, tighter budgets, and the challenge of staying relevant in a tough economic climate. Chipotle's top executives are sticking to their guns. They won't be dropping prices to attract more customers. This move has surprised a lot of people, especially since the restaurant industry is facing tough times and many competitors are offering deals to boost traffic. The logic here is that Chipotle believes its core customers, who tend to have higher incomes, are willing to pay for quality and clean ingredients. But in a market where people are feeling the pinch, refusing to offer more value could be risky. So, why are they betting on higher prices instead of bigger crowds? Let's break down the thinking behind this strategy. The term K-shaped economy has been popping up a lot lately, and it's basically a way to describe how different groups are experiencing the economy in totally opposite ways. Picture the letter K. One arm goes up, representing people whose incomes and fortunes are rising, while the other goes down, showing those who are struggling. Chipotle's CEO is leaning into this idea, saying their core customers are mostly high earners, over $100,000 a year, so the company is focusing on catering to them. This strategy means Chipotle is betting that wealthier customers will keep spending, even if everyone else is tightening their belts. It's a bold move, but it also highlights how businesses are adapting to a world where not everyone is feeling the same economic squeeze. Chipotle recently took a closer look at who their most loyal customers really are. According to their consumer research, about 60% of their core users have household incomes over $100,000 a year. These customers tend to be younger, digitally savvy, and place a high value on clean ingredients and high-protein meals. Chipotle believes this group aligns closely with their brand's focus on fresh, purposeful eating. So, when the company talks about catering to their core customer, they're really talking about appealing to wealthier, health-conscious individuals who are comfortable ordering online and willing to pay a premium for quality. So, Chipotle says that 60% of their main customers earn more than $100,000 a year. That's a pretty high-income crowd, and it definitely shapes how the company thinks about its menu and pricing. Instead of chasing everyone, Chipotle is focusing on people who are willing to pay more for things like clean ingredients and high-protein options. This strategy means they're leaning into premium offerings and digital convenience rather than trying to compete on price. But it also raises a big question. Can a restaurant built on quick, high-volume service really thrive if it's mostly catering to wealthier customers? Chipotle has zeroed in on a specific type of customer, someone who's young, comfortable with digital ordering, and really values clean ingredients and high-protein meals. This focus shows up in their menu, with options like protein cups and customizable bowls that highlight fresh, quality ingredients. Their messaging leans heavily on transparency and health, aiming to connect with people who want to know exactly what they're eating. By catering to this group, Chipotle hopes to build loyalty among customers who are willing to pay a bit more for food that matches their lifestyle. But it also means they're doubling down on digital tools and rewards to keep these tech-savvy diners coming back. Chipotle's main strategy for 2026 is to raise prices yet again, with plans for a 1 to 2% increase this year. The company says it's targeting its core customers, those with higher incomes who are willing to pay more for clean ingredients and high-protein meals. But for everyone else, these price hikes could make Chipotle feel less like an everyday lunch spot and more like an occasional treat. With flat sales forecasts and declining foot traffic, Chipotle is betting that wealthier customers will help offset the drop in visits. The big question is whether this move will keep the business thriving or just push more regular folks away. When you hear that Chipotle's margins are under pressure, it's basically saying their profits are getting squeezed. In business, margin is the difference between what a company earns from selling its food and what it costs to make and serve that food. If costs go up, like ingredients, wages, or rent, but sales don't rise as fast, the margin shrinks. That's why Chipotle's CFO is hinting at more price hikes. They're trying to protect those margins. If they can't, it means less money left over after paying the bills, which can impact everything from expansion plans to stock prices. Chipotle's new protein cups are basically single servings of chicken or steak, sold separately from the usual burrito or bowl. The idea is to offer a snack-sized option, but the price tag, over $4 for chicken and more than $6 for steak, matches what you'd pay for double protein in a regular meal. So, is this really an innovation, or just a clever way to squeeze more revenue from the same ingredients? For most customers, it feels like Chipotle is just repackaging what's already on the menu, hoping people will pay extra for convenience. Whether this catches on or not depends on whether folks see real value in paying premium prices for a cup of meat. Let's break down Chipotle's latest idea: selling cups of chicken for over $4 and steak for more than $6. On paper, it sounds like a snack-sized option, but in reality, it's just the same protein you'd get as an add-on to a burrito or bowl. Only now, it's repackaged as a standalone item. The price isn't any cheaper, so it's hard to see this as a value play for customers who are already feeling the pinch. Chipotle seems to think this will entice people to try something new. But honestly, most folks aren't likely to flock to the restaurant for a pricey cup of meat. It's a classic example of a company trying to innovate without really changing the value equation for its customers. A lot of investors and analysts think Chipotle should introduce a dollar menu to win back customers who care about value. But Chipotle isn't jumping on that bandwagon. Their leadership believes the brand stands apart from traditional fast food, focusing on quality ingredients and targeting higher-income, younger, digital-savvy customers. Instead of offering cheaper options, Chipotle is leaning into premium pricing and new menu items like protein cups. The idea is to keep the brand's image strong and avoid diluting its appeal, even if that means some folks feel priced out. Chipotle's latest strategy is all about focusing on customers with higher incomes, betting that these folks will pay extra for quality ingredients and protein-packed meals. But here's the catch: relying too much on wealthier customers can be risky. High earners aren't guaranteed to be loyal, and they don't necessarily visit often enough to keep stores busy. Chipotle's original success came from serving lots of people quickly, not just a few who spend more. If everyday customers feel left out or priced out, the brand could lose the steady foot traffic that made it a lunch staple in the first place. Relying on wealthy customers to keep a restaurant thriving sounds tempting, but it's not always a magic fix. Sure, high-income diners can spend more per visit, but they don't necessarily show up often enough to fill seats and keep the place buzzing. Chipotle's original business model was built on high volume, lots of people grabbing quick meals day after day. By focusing mainly on wealthier customers, the company risks losing the steady flow of everyday diners who made it a lunchtime staple. In the end, fewer visits from a select group can't replace the energy and revenue that comes from a packed restaurant. Chipotle built its reputation on serving lots of customers quickly, thanks to its assembly line setup and convenient locations. The idea was simple: keep prices reasonable, attract a steady stream of people, and move them through fast. But lately, Chipotle has shifted its focus toward wealthier customers and higher prices, hoping to make up for fewer visitors with bigger spending per person. The problem is, this approach risks breaking the original engine that powered their growth. If fewer people walk through the door, even high spenders can't keep the restaurants buzzing like before, and that could spell trouble for the whole business model. Let's take a look at how Chipotle stacks up against other fast casual chains, like Sweet Green. Both brands have tried to attract higher-income customers with premium ingredients and digital ordering, but that strategy hasn't always paid off. Sweet Green, for example, has struggled even more than Chipotle to keep traffic up, despite focusing on quality and trendy menu items. The big lesson here is that relying on wealthier customers alone doesn't solve the problem of declining visits. Fast casual restaurants need a steady flow of everyday customers to keep their business model humming, and ignoring that can lead to trouble, no matter how fancy the offerings are. Chipotle's new strategy zeroes in on high-income customers, but that move could actually hurt them in the long run. The brand originally built its success on being a go-to lunch spot for all kinds of people, not just those with bigger paychecks. By catering mainly to wealthier diners, Chipotle risks losing the everyday customers who helped fill their restaurants and drive repeat business. If regular folks start feeling priced out or less valued, they might simply stop coming as often. In a business that thrives on high traffic and convenience, narrowing the focus could mean fewer visits and, ultimately, slower growth. Chipotle built its reputation on being a convenient, go-to lunch spot, with customers returning out of habit and ease. But lately, rising prices are making folks pause and reconsider whether grabbing a burrito is still worth it. When lunch starts costing noticeably more, even loyal customers begin to weigh their options, especially if they're feeling the pinch. This shift shows how price increases can disrupt routines and push people to explore alternatives, breaking the cycle of repeat visits that once fueled Chipotle's growth. It's a classic example of how economics influences everyday decisions, right down to where we eat lunch. If you've noticed fewer people lining up at Chipotle lately, you're not alone, and the numbers back it up. Customer traffic has dropped for 4 straight quarters, and that's showing up in the company's sales figures. It's not just a blip. It's a sign that people aren't finding as much value in their burritos as before. When fewer customers walk through the door, it impacts everything from revenue to how busy the stores feel. So, what you see in your local Chipotle is actually a reflection of bigger trends happening across the whole company. Last fall, Chipotle's CEO highlighted a big shift. Younger customers, particularly those aged 25 to 35, were visiting less often. The reason? Economic pressures like unemployment, rising student loan payments, and slower wage growth were making it tougher for this group to justify dining out. This isn't just a Chipotle problem. Lots of restaurants are feeling the pinch as younger adults tighten their budgets. When a major chain notices a drop in traffic from such a key demographic, it's a sign that broader economic forces are at play. Understanding these pressures helps explain why Chipotle's sales and foot traffic have been on the decline. Chipotle's latest strategy to attract younger customers involves making the ordering process feel more like a game and offering bigger rewards. The idea is pretty simple. Add some fun and incentives to keep people coming back. But does gamifying the experience actually lead to more visits, or is it just a flashy gimmick? While these tactics might grab attention in the short term, the real question is whether they're enough to reverse the trend of declining foot traffic. Let's break down whether these moves are making a difference, or if Chipotle needs to rethink its approach. Declining traffic is basically the heartbeat of a restaurant business like Chipotle. When fewer people walk through the door, it's not just about selling less food. It signals that customers aren't finding enough value to keep coming back. Since Chipotle's model relies on high volume and quick service, a drop in visits means the core engine of their business is sputtering. Even if they try to make up for it with higher prices or catering to wealthier customers, you can't run a busy restaurant on fewer people. That's why traffic numbers matter so much. They reveal whether Chipotle's appeal is slipping and if their strategies are actually working. When Chipotle says it expects flat same-store sales in 2026, that's a pretty clear signal. They don't see customer traffic bouncing back anytime soon. In the world of restaurants, flat sales aren't just about staying steady. They often mean the business is struggling to grow, especially after a year of declining visits. This kind of outlook can make investors nervous, since companies are usually expected to keep expanding. For Chipotle, it raises questions about whether their current strategies, like targeting wealthier customers and raising prices, will actually help turn things around. We'll break down what this could mean for their future and why it matters in the bigger economic picture. When a new CEO steps in, Investors often watch closely to see how their decisions impact the company's direction. In Chipotle's case, the CEO has been at the helm for roughly 18 months, and during that time, the stock price has taken a significant hit. Leadership changes can shake up investor confidence, especially if the company's performance doesn't improve or if strategic moves seem risky. Investors want to see clear plans and positive results, so when things go south, it can lead to doubts about the leadership's ability to turn things around. This dynamic is a big reason why stock prices can react so sharply to who's in charge and what they're doing. So Chipotle's big moves right now are pretty clear. They're raising prices by about 1 to 2%, focusing on customers who earn over $100,000 a year, and rolling out protein cups as a new snack option. The idea is to lean into their core audience, people who value clean ingredients and high protein and are willing to pay a premium for it. But here's the question. Are these strategies enough to fix their declining traffic and sales? Betting on wealthier customers and pricier menu items might boost revenue per visit, but it doesn't guarantee more people will walk through the door. And while protein cups sound novel, it's hard to say if they'll actually draw in new customers or just repurpose what's already on the menu. Even with all the recent setbacks, Chipotle isn't exactly on the brink of collapse. The company continues to generate billions in revenue each quarter and remains profitable, with hundreds of millions in net income. In fact, Chipotle is moving forward with plans to open over 300 new restaurants this year, showing confidence in its long-term growth. So while the headlines might sound dire, it's important to remember that Chipotle is still a major player in the fast casual game. The real question is whether these expansion efforts and new strategies will be enough to turn things around for the brand. In today's stock market, simply maintaining your current level isn't enough. Investors and analysts expect companies to consistently show growth, whether it's through higher sales, more customers, or expanding into new markets. If a company's numbers stay flat, it's often seen as a warning sign, even if they're still making plenty of money. This pressure comes from the idea that stocks should always be moving upward, so anything less can lead to disappointment and falling share prices. It's a bit like running on a treadmill. If you stop, even for a moment, people worry you're falling behind. Chipotle's recent struggles aren't just about one company. They're a snapshot of bigger trends in the restaurant world and the economy. As more people tighten their budgets, even popular chains are feeling the pinch, with fewer customers walking through the door and sales staying flat. The push to cater to wealthier diners and raise prices highlights how businesses are adapting to a so-called K-shaped economy, where some groups are doing well and others are falling behind. In the stock market, steady profits aren't enough. Investors expect constant growth, and any slowdown can send shares tumbling. So, Chipotle's story is really about how companies are navigating shifting consumer habits, rising costs, and the relentless pressure to keep growing in today's economic landscape.